It has now officially happened. The Federal Reserve has just cut US interest rates down to 4%. This is the single largest central bank in the world, with over $7 trillion in total assets. That's more than the combined assets of the central banks of England, Italy, France, and Norway. But more importantly, the Fed controls the global supply of US dollars. The reduction in interest rates that the Federal Reserve just did could have huge implications for Bitcoin. After all, liquidity is largely shaped by what global central banks are doing with interest rates. When rates are cut, borrowing becomes cheaper and more money flows into the system, making the available money in the system expand. And when rates are raised, borrowing costs rise, money drains out, and liquidity tightens. For example, if we look at the US M2 money supply, we see that it began declining in 2022. And if we put US interest rates on top, we see this decline actually coincided with the period when the US central bank was raising interest rates. But by August of 2023, the Fed paused rate hikes and eventually shifted towards rate cuts. That was the moment when the US money supply bottomed and started to climb again. And this isn't just a US story. Across the globe, the same principle applies. When central banks ease, liquidity rises, and when they tighten, liquidity falls. Today, central banks around the world are cutting rates at one of the fastest pace in history, with 88 cuts in the past 8 months alone. This has shaped our entire trading strategy at Bravos Research to position into assets that benefit from this kind of macroeconomic backdrop. The only other time we've seen such an elevated level of coordinated easing was in 2020 during the pandemic. This wave of global rate cuts is a strong tailwind for liquidity conditions to ease. And now, with the US central bank cutting rates, they are essentially adding fuel to the fire. And this liquidity is already telling us where Bitcoin will be by the end of 2025, as we'll show you later in this video. By the way, we're celebrating our 5th birthday at Bravos Research. Our mission has been to provide investors with clear, data-driven research that cuts through the noise. And the truth is, we wouldn't be here without the support of all of you who watch these videos and follow our work. To celebrate, we're offering a special discount on our service. If you've been thinking about joining, this is your chance to get full access to every trade we take in real time, and our complete trading strategy for navigating the crypto markets step by step. We don't do such discounts often, so make sure to capitalize on it. Today's rate cuts by the Fed has actually gotten a lot of investors concerned. After all, most US rate cut cycles have begun when the economy was already too weak. Since 1954, almost every time the Fed lowered rates, it was either right before or during an economic recession, with the only exceptions being 1967, 1984, and 1995. And history shows that a recessionary backdrop has been quite unfavorable for risk markets. Just look at the S&P 500, for example. It has declined during every single one of these economic downturns. With the labor market now showing signs of weakness, that same risk is present today for risk assets like Bitcoin. One of the clearest signals of this slowdown can be seen through something called the Non-Farm Payroll Jobs Report, which shows the number of jobs created in the US. Since 2021, this metric has been trending lower, reflecting a steady loss of momentum in the labor market. And in June 2025, the data actually turned negative, showing that the economy lost jobs rather than added them. If this kind of a trend persists, then it's quite possible that the economy indeed does slip into a recession, which would likely prove very painful for risk assets. However, today's labor market doesn't yet resemble the kind of breakdowns we've seen heading into past recessions. Take the ratio of job openings to unemployed workers, for instance. In 2021, it peaked at 2, meaning there were 2 jobs for every 1 person looking. That ratio has since fallen to roughly 1, signaling a slowdown, but not an outright collapse. For comparison, during the 2001 and 2008 recessions, this ratio dropped well below the 0.8 level, pointing to severe labor market stress. The only exception was the 2020 downturn, which was triggered by a black swan event rather than structural weakness. So, while the labor market is undeniably cooling, it hasn't yet reached recessionary levels. And with the Fed beginning to cut rates in a market that is softening but still intact, the odds favor stabilization rather than a full-blown contraction. That also helps explain why small businesses are reporting a constructive outlook today. Data from the NFIB survey shows that these companies see this as the best time to expand operations since 2020. Historically, jumps in small business optimism like this tend to occur in the middle of growth cycles, not heading into recessions. Heading into each of the last 4 recessions, small businesses were turning pessimistic instead. So what we have today is a scenario where the Fed is cutting rates without an imminent recession. If we look at this chart of the US stock market performance following rate cuts, the difference is striking. When cuts happen during a recession, stocks fall about 10% on average in the following year. When cuts take place outside of a recession, markets instead tend to rally by roughly 15%. And given the strong correlation between US equities and Bitcoin, this same principle likely applies for Bitcoin. With the world's biggest central bank now cutting rates, it's going to mechanically put upwards pressure on this chart of global liquidity. And that, in our opinion, is a significant catalyst that's present for Bitcoin today. Because if we put the chart of Bitcoin on top, we see that the two lines have quite a close relationship. Periods when global liquidity is moving higher, Bitcoin tends to rally. And times when liquidity was contracting, like here in 2014, 2018, and 2022, Bitcoin also experienced sharp drawdowns. In fact, this global liquidity chart can help us anticipate where Bitcoin will be in a few months from now, as I'll show you in just a second. But Bitcoin's relationship with global liquidity becomes even clearer when we look at this chart. It shows how often Bitcoin moves in the same direction as global liquidity, a concept known as directional alignment. Right here, we can see Bitcoin's alignment with liquidity sits at 83%. In other words, more than 8 out of 10 times, Bitcoin follows the same directional trend as global liquidity. For comparison, the US stock market comes in at 81%, gold at 68%, emerging markets at 60%, and treasury bonds at only 45%. So it's evident that out of all major asset classes, Bitcoin is the most sensitive to changes in global liquidity. These kinds of quantitative edges are what we regularly use at Bravo's research to help us capture high conviction setups on Bitcoin. Now, if we take this chart of global liquidity and shift it forward by about 3 months, something very interesting happens. Bitcoin doesn't just closely track the direction of liquidity, it tends to follow it with about a short lag. This is a relationship we also highlighted back in April of 2025, when Bitcoin was still trading near $80,000 and investors were calling for a bear market. At that point, global liquidity had already bottomed and was turning higher, which kept us constructive on Bitcoin. Not long after, Bitcoin rebounded sharply and pushed to new all-time highs. This is exactly why we built Bravo's research, to help investors cut through the noise and stay on the right side of major crypto moves based on the data. Through our 3 weekly premium videos and trade alerts, we walk members through these same macro signals in detail, showing not just what's happening right now, but also how to position for it. You can secure our limited time discount offer using the link in the description below. Today, liquidity is once again signaling a bottom in Bitcoin over the coming weeks, with the setup pointing to a move toward the $170,000 region by the end of 2025. Of course, this isn't a guarantee. As you can see, sometimes Bitcoin tends to overshoot, like here, and sometimes it falls short, like here. However, with the Fed cutting rates, as far as the labor market doesn't break, we believe that reaching the 150,000 to 170,000 region by the end of 2025 is a real possibility. By the way, make sure to lock in your membership before our birthday discount expires. We've already capitalized on this bull run with multiple profitable trades, like 30% on Bitcoin, 36% on Solana, and even an 83% move on Ethereum, all while keeping most of our losses contained to around 5%. Just last week, we outlined our full crypto strategy for this phase of the bull run in a premium video. If you're interested in these real-time alerts and in-depth market coverage, make sure to join our crypto community using the link in the description below.